Wall Street snatches the hype, but Europe is grabbing the gains. Are investors looking in the wrong place? This year, Europe has muscled its way back onto the global market stage. Among the world's top 20 performing stock markets, every second index is European, a feat we've seen only 3 times before. But not everyone's convinced that the rally has staying power, with plenty of risks that could cool sentiment. So as we head into the new year, does the money keep flowing, or was this as good as it gets? Georges Debbas is head of European equity derivatives strategy for BNP Paribas. So Georges, investor confidence in Europe has snapped back this year. What's been the real catalyst behind that shift?
I think there has been a few factors that have allowed Europe to perform quite well, which is not very common, as you've noticed. I would say the first one was excessive pessimism coming into the year, where I suppose there was a lot of negative connotation around the European and the European as a bloc when the Trump administration has been elected a year ago. But quickly, very quickly, investors have started understanding that that was actually a positive catalyst for politicians in order to actually start putting the right things into place. That was one aspect, I think, excess pessimism. The second one is also valuation. Europe actually has become extremely attractive on a relative basis compared to other regions, especially the US. And finally, we've had quite a large shift in politics this year with the German new government and decision to have excess fiscal spending that should allow a return to growth, especially from our first big and largest country and hence economy.
Well, Europe is starting to be seen as the safer, less tech-heavy alternative compared to the AI-led rally in the US. So if the bubble bursts, is Europe the place to hide?
Well, yes and no, in the sense that potentially economically speaking, we have less places that can burst. But as history showed us, whenever the US sneezes, we tend to catch a cold. But yes, it's true that for the first time, so if you take a step back, Europe has always been seen as the more cyclical and the less quality compared to the US, which shows a bit more resilience and less rate sensitivity because of their large service-led economy. But right now, the contribution of AI has been such a large piece of performance that if indeed you do have a bit of a downturn in that sector, it could theoretically be a bit more aggressive in the US than necessarily in Europe. So on the downside, if we do get the tech crash, yes, it is true that potentially Europe can outperform on a relative basis the US, but will still be actually down, to say the least.
Analysts are saying that European earnings may finally close the gap with the US. Stock 600 profits are forecasted to jump 11% next year. Does that sound likely to you?
Well, on our numbers, which we do it on a bottom-up perspective, Europe is expected to grow between 7 and 8% next year. So not really 11%. But nevertheless, compared to history, 7 to 8% is still a step forward. As a house, we're quite constructive on Europe, and we do actually see an uplift in profitability next year, coming from 2 important factors. The first one, top-down and macro. We do all know that the fiscal spending is coming, and that will actually allow a bit more money to come into the economy and hence have a better growth prospect. But also from a micro perspective, one of the things that has not allowed Europe to perform positively has been a bit of an inventory gluttony that we've had over the past 2 to 3 years, because other regions like China have flooded of our market where they're over capacity. And right now, that destocking has normalized. So from a micro perspective, you have a destocking that's normalized, and from a top-down, you have excess spending that's coming. Both of them should allow us to perform quite positively into next year. Now, the reason why we are also constructive on the equity market and not just on earnings are for 2 factors. The first one is, despite having a good year, as you mentioned, a lot of the flow has not yet come in. So we've had a great performance, but people are still on their way to Europe. And that could change next year when skepticism becomes a bit more positive. So that's quite an important factor. The second important factor, as you well know, for equity market, what is important is the second derivative. As long as we go from no earning growth to better earning growth, and we see that trajectory, that will allow for the velocity and momentum to continue to be positive. And these 2 effects keep us a bit more constructive on Europe into next year.
Well, let's keep on the macro side, and expectations are building for stronger Eurozone growth and inflation that would keep the ECB on hold for longer. But if the next move is a hike, will that curb equities performance?
We don't think so at this point. Obviously, there are some sectors that could be a bit more less hindered, but for the time being, we're only seeing the benefit of the rate cuts because, there's a delay between rate cuts and also the rate hikes that feeds into the economy, and we're only now bearing the fruits positively about the rate cut that should allow a bit more upside into next year.
That was Debbas from BNP Paribas. Don't forget, you can watch more videos on Reuters.com.